Chapter number 4, Key Takeaways. Audit risk. Audit risk is the risk of expressing an inappropriate audit opinion on financial statements that are materially misstated. The components of audit risk includes inherent risk, control risk, detection risk. Audit risk can be expressed as a product of inherent risk, control risk, and detection risk. Therefore, audit risk equals to inherent risk into control risk into detection risk. Auditors are required to assess the risk of material misstatements at two levels. The first is at the overall financial statement level, which refers to the risk of material misstatements that relate pervasively to the financial statements as a whole and potentially affects many assertions. And second one relates to risk identifiable with specific assertions at the class of transactions, account balance, or disclosure level. A set of internally generated policies and procedures adopted by the management of an enterprise is a prerequisite for an organization's efficient and effective performance. It is thus a primary responsibility of every management to create and maintain an adequate system of internal control appropriate to the size and nature of the business entity. Internal control is the process designed, implemented, and maintained by those charged with governance, management, and other personnel to provide reasonable assurance about the achievement of an entity's objective with regard to reliability of the financial reporting, effectiveness and efficiency of the operations, safeguarding of assets, and compliance with applicable laws and regulations. Internal control, no matter how effective, can provide an entity with only reasonable assurance and not absolute assurance about achieving the entity's operational, financial reporting, and compliance objectives. Components of internal control includes control environment, entities risk assessment process, the information system, including the related business processes relevant to financial reporting and communication, control activities, and monitoring of controls. A review of internal control system enables auditor to formulate his opinion as to the reliance he may place on the system itself. That is, whether the system is such as would enable the management to produce a true and fair set of financial statements and to locate the area of weaknesses in the system so that the audit program and the nature, timing, and extent of subjective and compliance audit procedures can be adjusted to meet the situation. In accordance with SA 265, it is auditor's responsibility to communicate appropriately to those charged with governance and management deficiencies in internal control that the auditor has identified during the audit and that, in the auditor's professional judgment, are of sufficient importance to merit their respective attentions. Based on risks of material misstatements identified and assessed by the auditor develops responses to assessed risks. SA 330 deals with the auditor's responsibility to design and implement responses to the risks of material misstatements identified and assessed by the auditor in accordance with SA 315. Corporate internal controls are part of governance mechanisms of every organization, and whether a company adopts a global internal control framework, global internal control framework, or develop its own, management should always be guided by the need to safeguard business value. There are a number of global internal control frameworks that provide guidance to entities for developing and establishing their internal control systems.